We've got Kumar Subbiah, who's the Chief Financial Officer of the company, joining us this morning. Kumar, good morning, and thanks so much for taking the time. Tough quarter is what is evident to us, but you tell us what you experienced. Margins contracted, raw material pressure exists. Is that what stood out?
Yeah, true. That's true. I think the positive aspect was that we had a double-digit growth in quarter three, year on year. Generally, quarter three is slightly a weaker quarter compared to the rest of the three quarters. So, fact that we were able to hold on to a similar level of revenue in quarter three versus quarter two, and over about 11% growth over this year-on-year basis was something positive. You're right. Raw material costs moved up in quarter three in line with what we had anticipated. We managed to take some price increases, particularly in some categories like passenger car radial tires, truck and bus radial, and light commercial vehicle. And during the course of the quarter at different points in time. So to the extent of gap between the price increase and raw material increase had some impact on our gross margins.
Kumar, just also comment on the revenue mix, because replacement accounting for 54% now of that revenue mix, and OEM has been on the passenger car side a little slow, one would think, and so that is having a bearing as well. Does that stay the way that it is heading into the fourth quarter as well? Does it increase replacement?
No, so far in the first 9 months of the year, replacement had a strong growth, double-digit growth year on year in all three quarters. So therefore, that was very positive. In quarter three, in fact, on year, even OEMs grew. We expect quarter four OEM growth to be in double digits for us, considering some new orders that we have got from OEMs. So weakness in OEM sales that we are seeing in terms of the end product is not going to affect us in quarter four, mainly on account of the fact that we have got some new orders and therefore we are expected to grow in quarter four.
Okay. I also want to understand about the product mix, because that ultimately is going to contribute to the kind of margin picture that you will have, Kumar, heading into the fourth quarter as well. One would assume that because of the impact of raw material costs, but also I would think because of that mix, you have had a contraction in the margins. Does the margin stay depressed as it is right now, heading into the last quarter, or do we see some of the impact of the price increases that you have currently taken pan out in the fourth quarter and an expansion therein?
No, primary reason for drop in margin was in quarter three and also in the first 9 months was largely on account of raw material costs that we could not completely pass on, and we had passed on at different points in time. That was a primary driver. We didn't have any adverse mix in the form of categories as well as in terms of customers, that is segments, replacement, OEM, and international business. Towards the end of quarter three, we took some price increases. We expect raw material prices to be more or less stable in quarter four in line with quarter three, possibly maybe a percentage change over quarter three. That is what we are expecting. At that level, if any price increase that we would be taking...
Kumar, higher or lower? Percentage point increase, higher or lower?
No, I think it'll be in the plus or minus 1%, I would say.
Like that, okay.
Yeah, it could be in that range. And assuming the raw material cost would be in that level, any increase in price would translate to, would be margin accretive. Okay. In the past 9 to 12 months, the price increases that we took did not lead to any margin expansion because the raw material continued to increase during this period. As we expect raw material prices to be stable, price increase should actually translate to positive impact on margins.
Couple of questions on capacity expansion. First, of course, on utilization. Where does it stand right now in your existing capacity? Because you've got the proposed capex at Nagpur, and I'm wondering whether or not, based on the current utilization, you need to step on the gas there or ease off.
Okay, overall capacity utilization was healthy in quarter three, particularly in categories like passenger car radial tires. You are aware that in the month of September, we also had commissioned truck and bus radial capacity at Chennai. Okay, that is also ramping up nicely. So capacity utilization is upwards of 80% in passenger car radial, two-wheeler tires, truck and bus radial tires overall. Utilization is a little lower in bias categories, particularly truck and bus bias and LCVs. And therefore we expect utilization to be at this level, particularly in radial categories and two-wheeler categories going into quarter four. The second question on Nagpur, it is an enabling approval that we have got from board. Our current capacity utilization of Nagpur is closer to in the range of 85 to 90%. Considering long lead time involved in setting up a project, we have taken an enabling approval for us to expand our two-wheeler capacity at Nagpur.
Last question, and I'll toss it to Neeraj. I want to know also about the inventory levels as they stand right now. One would assume that they might just have inched up in the recent past. Can you help us understand that picture?
If you break inventories into two, raw material inventory saw a correction in quarter three. In quarter two, we had a higher level of raw material inventory, largely on account of increase in lead times in the imports, particularly for natural rubber and other categories. We are very close to normal level in case of raw materials. Finished goods, we are in the range of about 20, 23, 24 days, which is a normal level as of end December. Given the choice in some categories, we would have liked slightly higher level of inventory. As we go into quarter four, in the month of March, generally the sales is little higher than the rest of the month. So therefore, we are comfortable at a normal level.
Mr. Subbiah, this is Neeraj here. Good morning.
Good morning, Neeraj.
I would love to understand how you think about the year at large, sir. Because one, there's this large chatter of how auto demand is fluid with maybe a bit of a downward bias. So yes, replacement demand could help you, but would overall demand conditions as they stand, do they look subdued, and will they impact the volume growth for a company like yours?
Okay, Neeraj, for us, we are working towards a double-digit growth as far as the current year is concerned. Okay, in the first 9 months, we grew by about 9.4% over the last year. And in quarter three, we grew by about 11.3%. It's a mix of both volume growth and price growth. 70% was volume growth and 30% price growth. So to deliver a double-digit growth, say at least 10%, quarter four growth has to be higher than 10% year on year. So we are positive with respect to delivering a double-digit growth as far as quarter four is concerned. You are right with respect to OEM demand is a little subdued. For us, not only in the first 9 months, even in the previous year also, our growth was higher in replacement and international business and lower in OEMs. So the growth in OEM also depends on what happens to our own share of business with respect to OEMs and our level of participation in the new launches. Therefore, that is looking a little healthy. So we look forward to a double-digit growth on a full year basis as far as this year is concerned. Maybe we'll share an update with respect to our old plan for next year in the next call.
Okay, fair call. So maybe in that quarter, sir, what I would love to know effectively is that if the OEM demand comes back and you choose to participate, can that add a bit of an upside layer to the volumes? I mean, the overall growth and the pricing would be maybe in your control, maybe market conditions, but the volume picture would essentially be the factor also of the OEM demand and your participation. So would love to know that then. The second part of my question is this, sir. The picture is unclear, but with an assumption that, or a hypothesis, that China does stimulate its economy in whichever shape or form it does because it needs to. And that enhances some of the prices of raw materials across the board, across industries, across the world, if you will. Does that continue to put in more pressure on your raw material cost? Or are there mitigating effects at play that you foresee over the course of the next 6 to 9 months?
Ideally, the raw material prices, particularly what goes into tires, should have corrected in quarter three. And we were looking forward to some correction, particularly in the international rubber prices and some of the crude derivatives like synthetic rubber or caprolactam. It has not yet happened. Okay. And you are aware, China is the largest consumer of natural rubber in the world, accounting for almost 1/3 of the total demand. So therefore, any supply demand change in China would certainly have an effect on raw material prices. Otherwise, anything in China with respect to any changes in the economy or in their growth, etc., may not have much impact on raw material prices from the current base level. Okay, and so therefore, however, if Chinese demand for raw material increases on account of higher tire production or higher auto demand, etc., may have a little bit of impact. Uh, Personally, I feel, from here onwards, raw material prices going up is little lower. Chances are lower unless the crude goes up from $80 level to a higher level. So we look forward to slightly a stable to a downward kind of a raw material situation in the next 6 months.
That's a point well made. Kumar, attention is being drawn by my team to the Camu acquisition. They want to know about the timeline of the acquisition and also the implications for the margins when it does come to pass, because it's been pointed out that the margins are higher in that business.
Okay, and in terms of timelines, we expect there are formalities with respect to certain approvals like antitrust and local approvals required from the local bodies, local government agencies. So we expect it to happen sometime in the month of May and June. With respect to margins, we expect it to be a margin accretive. The compact construction tires and tracks business that we are acquiring from them, their margins have been higher than Ceat's average margins. So therefore, at the normal scale of
Kumar,
production,
it would help to just give us a sense, ceteris paribus, there are so many moving parts, you've talked about raw material prices, etc. But just to give us an indication, FY26, you're saying that it's margin accretive. Can you give us a sense of how much?
No, okay, see, hopefully, I think we'll be able to consolidate Camu results for a 9-month period going into next financial year, not full 12 months. Our expectation is that margin is at mid-teens level as far as Camu is concerned. Camu is about a 180 to $200 million kind of a business, and which would be maybe 14-15% of our total revenue share. So from that standpoint, to the extent of that margin gap, we'll have a margin accretive impact on our overall margins. I think we'll be able to share more details once we get the business and start running it. Possibly we'll have a little more visibility and little more understanding of its impact on margins with respect to this. At this point in time, we expect it to be mid-teens, and overall we expect it to be accretive. Exact details we'll share it with you once we start handling the business.
Subbiah, leave it at that. Thanks so much and all the best for the quarters ahead.